And so we can't always wait for somebody who says, "Oh yeah, by the way, we were in recession back then," and and this is kind of where the problem is because it affects our money right now. Hey y'all, Nev here from One Deal Away, and today's video, I really want to focus a little bit on kind of what's happening. I typically have kind of like a schedule of what I like to teach and what I like to talk about, but with all these things happening in the market, I thought that it was irresponsible of me to just focus on doing my thing, because we all have things on our mind. There have been things happening with COVID-19, or also known as coronavirus. It has had effects on markets over the last few weeks. The money for many people has disappeared and vanished, and we're all wondering about what to do when it comes to our investing. And really, at the end of the day, what's the future? I don't know what the future actually holds, but in today's episode, I wanted to share with you some of my thoughts of what I think is happening, what I have seen, and really help you start thinking differently, perhaps start those creative juices flowing, and help you really start getting back into the pace of power. When there's a lot of uncertainty, there's also a lot of fear, because when we're certain about something is going to happen, we can move forward, well, with certainty, right? If I know, for example, to quote Tony Robbins, that the floor that is before me is going to support me fully, I'm going to step full on and keep on marching. But the moment that I have a distrust into this floor, and I'm not sure if it's going to support me, right? And if you've ever been in a construction zone, you kind of put your foot in, you sort of tap it, you put a little bit of weight, you're listening for the creaks. And imagine if that's kind of how you were walking, if you only had to walk, I don't know, 100 yards, right? If you're certain that the floor is going to support you, that 100 yards, I mean, you can sprint it in a few seconds, right? You can walk it in, a few seconds as well. But if you're quite uncertain what that is going to do, you're going to be questioning every single move that you make. And that is the time when we start losing belief in ourselves, in the environment, in everything else around us, because we're really just trying to sort of navigate. And that's kind of where I feel like a lot of people are when it comes to money and markets and investing and just life in general. And so I don't know if you believe that COVID is real or not, if you believe that it's a hoax, if you believe that it's another cold or flu, or if you believe that it is pandemic and something that can kill you. What we can all, I think, agree on that is has had a major impact on our markets and economy, and not just the United States, but all over the world. You likely know that it started in China, and China has experienced a severe sort of drop in economic productivity because they had to isolate everybody. They stopped the factories, everybody was at home, and really work, production, shipments, everything stopped. So even if you were in the United States and you were depending on some of the stuff coming your way, you couldn't get it. So now the part of the problem that kind of happened in China started to affect people around the world because of the shipments. And if you were using China to make your products, now you couldn't deliver it to your customers, even though you're fine wherever you are. Some of the other companies, like automakers and playmakers and phone makers and makers, everybody is doing some sort of business with China. We are very much interconnected in today's world. And, only 50 years ago, one country could go down, everybody else is fine, because most of us sort of produce things in-house, so to say. A lot of manufacturing was in the United States, and so it didn't really matter as much. Our financial industries or financial sector or financial institutions, however you want to call it, were also not as interconnected as they are today. Today, we're all sort of very much connected and very much functioning like one global economy. Even though there are pockets that might do a little bit better, a little bit worse, there are industries that do slightly better, slightly worse. At the end of the day, we're all interconnected when it comes to our money and finance and sort of how the world thinks about money and finance. And that's kind of what I want to talk about today, is sort of what are some of the things that I have been watching out for, what I have been sharing with some of my clients, my students, with my family, with my friends, and of course things that I am thinking for myself and doing for myself. So one of the things that you likely have noticed, that if you have been watching markets, and when I talk about markets here, I am specifically talking about the paper assets market. So I'm talking about stocks, bonds, mutual funds, ETFs. Now, before we go in, I want to briefly explain what one is versus the other. Stock, as I'm sure you know, is only it's a portion, it's an equity portion ownership of a particular company. Typically, it's a public company that is trading on some sort of public exchange, right? So Apple might be an example of it. And you buy a share of Apple, you basically have a portion share equity in what's happening within that particular company. Bonds is basically a debt. It could be a corporate bond, government bond, municipal bond, junk bond, bond. But bonds is basically debt. And when you purchase bonds, you are really purchasing debt. So you're sort of the lender, right? And so if I was to issue a bond, for example, and you were to purchase it and you were to lend me, say, $1,000, and whatever we agree, I have to pay you that $1,000 back plus whatever interest we agreed on. One thing to also keep in mind with bonds is that when the bond is sort of inverse related. So let's look at it. So if this is going to be the price, this is going to be the yield or return. As the yield goes down, the price goes up. As the yield goes up, the price goes down. That's sort of one of the things to kind of look at it. And so as the yields are dropping, that's actually considered a bull market or the positive market in bonds. I know it's crazy, but that's just kind of how it works. I just want to explain to you. Earlier in the video, I talked about Tony Robbins and kind of some of his analogies of what he used about the whole certainty, uncertainty components. And he went out and wrote a book called Money, where he interviewed all of these, what we would call smart money folks, people that are in higher positions, that are doing different things. The book, you're absolutely welcome to get it. I'm not affiliated in any way, shape, or form. I don't even know the guy. So, but it is out there. And, some of those folks that are in that book have been the folks that have been teaching and talking a lot about kind of like money and wealth and how do you do stuff. But a vast majority of them focus on the market, which is the stock market. And so I want to use something from that book that I have learned, that I have known a long time, but I got reminded of, and that's from John Bogle, the founder of Vanguard Funds, where he talks about mutual funds. And so for many of us, a vast majority of our wealth is in retirement accounts. So 401k, 403b, IRAs, whether it's traditional Roth, it doesn't matter. Like that's where a vast majority of individuals have money. And vast of those retirement funds are in mutual funds. And what he talked about mutual funds is something that the vast majority of people don't know. I certainly didn't know this way back when I was thinking I was investing and I was speculating and ended up losing a lot of money. And it was a very similar period to this. It was 2008. Obviously it wasn't COVID-19. It wasn't the pandemic, but it was the liquidity crisis. And that's kind of what I want to talk about a little bit today and kind of focus on some of those things. But he talked about kind of how you go in and invest, and there's a huge problem with mutual funds, and that's the part of what's also in the paper markets. So you will go out, you buy this mutual fund, and a lot of people are talking about just get a no-load fund and you'll be fine. And no-load basically means that there's like no fees or upfront costs when you buy or when you sell. But there are fees, there are ongoing fees that can range anywhere from like 2 to 5, 6%. And it's basically a basket again of all these different things that are kind of being put in. Mostly are going to be equities. Sometimes it's mixed of equities and bonds. So it's like all over the place that you can buy. And what he was talking about is that there's this huge problem where you and I will put in 100% of the money, right? Because we're putting money into that account. We take 100% of the risk, meaning if it goes up, cool, but if it goes down, like we lose our money. But because of all of these fees that are associated with it, many of which we're not even familiar or known about because it's not being advertised and most of us don't even know that they exist, we only end up with about 30% of our money. So for that reason, I am not a huge fan of mutual funds, and I cannot recommend it more for people not to do that. But I also understand when it comes to retirement, that's the only option we have. So those mutual funds are the only option. There are going to be funds that you have heard, like that you might see that kind of talk about, like the 2030, 2040, 2050, which is basically the funds that are designed to utilize potentially some sort of math combination. You know how they do the whole thing of like, all right, so here's your nest egg, and if you're this age, then this should be bonds, and then this should be stocks over here, right? And then as you age, then this is going to be bonds over here, and stocks get smaller. And so that's what these 2030, 2040, etc. funds actually end up doing. It's automatically switching from predominantly equity when you're young to predominantly bonds. And there have been a lot of folks who are much more knowledgeable about trading in the markets and investing in paper assets than I am, who have been talking about and calling that these are the worst funds that you can have, yet a lot of people have them. ETFs are basically derivatives. It's sort of a basket of all these different things. They have kind of created this virtual trading thing where you can buy a share of SPY, for example, SPIDER sometimes called. Some people call it SPY, whatever you want. That's S&P 500 ETF. And that ETF basically just follows what happens with S&P 500 as a whole. Now, S&P 500 is an index, just like Dow Jones Industrial Average is an index. It follows, S&P follows the 500 largest companies, NASDAQ mostly follows technology, and Dow basically is what they're called like the blue chip. They're just sort of the largest of the companies. All of these indices, I don't know, what's the plural? I have no clue. But all of them, what's in their basket, so to speak, of what they're tracking changes all the time because they're focusing on the top performers. The moment that you're not a top performer, you drop out of it, the next one picks up. So that's kind of how that works. So those baskets are a fairly good indication of kind of what's happening, but for individual stocks, it might not necessarily matter as much. I'm going to use an example of Inovia, I want to say, and the ticker symbol is INO. INO is a medical pharmaceutical company. This is their ticker symbol, and even when the market was going down and crashing, having all these problems, they were actually going up, having returns of like well over 100% in a very short period of time because they were working on COVID virus vaccine or remedy or whatever. That stock has also dropped since we've entered this economic place of where we are, and I'm going to share kind of where we are and what's happening. But just wanted to point out that even though market kind of melts, there are pockets that perform really well. Where we are with the market right now. So at the height of the market, we were at 29,000 plus. It was a little bit more than 29,000. Where we ended up dropping is to about 29,000 plus minus, roughly speaking. And Friday, so today is a Saturday, March 13th. So on Friday, March 12th, the Dow actually had gone up nearly 2,000 points. This is sort of an insane gain for a day. It went up like 9 point something percent, but it also has been dropping severely. At the lowest part so far, because we don't know where it's going to go, at the lowest part so far, we've already dropped about 30 plus percent since the height of the market. And even though we have gone up 10%, we're still down well over 20%. Now, to explain some of the terminology that you might be hearing, so that's kind of what my goal is here, to help you start understanding some of the concepts. What Correction is going to be, obviously when the market kind of start going down. And correction territory is, typically around 10% or so. When we started getting into recession is when we start hitting 20%. Unfortunately, the government and the central banks cannot call something a recession until a few other parameters like GDP, employment, all the other stuff have been also dropping at particular levels, and that has been happening for 2 consecutive quarters. A quarter is 3 months, so right now we're wrapping up a quarter number 1 of 2020, and boy has it been an interesting quarter. But if this was to continue for 2 months, I mean, we're looking well into July, August, September before they can even call it that we were in recession. Between now and September, there's a lot of time. And so we can't always wait for somebody who says, oh yeah, by the way, we were in recession back then. And, and this is kind of where the problem is, because it affects our money right now. And that's kind of where the problem comes in, is that a lot of the technical sort of calls for things that come out of official channels cannot happen until we've been it for a while. And while it's helpful to know that, hey, that's what we've been, it's not helping us in today. It's not helping us figure out, what do we do today? What does make most sense to do for us today? So here's some of the things that what people call smart money. And smart money are typically individuals that are connected at a much higher level. So these are going to be the executives at some of the largest corporations and banks. These are going to be government officials. These are going to be the owners of the largest funds, VCs, and that kind of stuff. So we're talking people with a lot of money. When I say a lot of money, I don't mean $1 million, because to them, that's probably something they spend on a weekend. We are talking people who have billions of dollars, trillions of dollars to invest and kind of go out and do things. So that's kind of who we're talking about when we talk about those things. Some of the things that have been happening, you might actually already be aware, is that some of the largest companies' CEOs are leaving. I actually just recently have heard that Bill Gates is also stepping down, even as a chairman, like completely stepping away from everything. And that also sends clues. I think everything that ends up happening, it's important to watch and not just to sort of like, oh, cool, interesting, but to look at it and say, oh, cool, interesting, that is a clue. Everything that is happening is a clue, and we need to be very diligent about putting those clues together, connecting them, so that we can inform a decision for ourselves of what makes sense to do. Some of the folks online have been calling to say, and I agree with them, to say, if you're not quite sure what to do, watch what smart money does. Watch what people who are in certain positions do, and then do what they're telling you to do. Don't do what they're, or do what they're doing. Don't do what they're telling you to do. So watch what they're doing and try to mimic them. So what are the good things to potentially invest in and buy? That is what's on everybody's mind, so that's why we put it over here in the investing component. So let's talk about that. And for that, you're going to have to tune in the next episode, and I promise I will talk about it. Until next time, stay forever money blessed, and do remember, you are only one deal away.
I want you to be happy. Don't you want to be happy? I want to be happy.